Crude oil isn't just a fuel, it's the bloodstream of the global economy. Every barrel traded carries with it the weight of inflation expectations, geopolitical tension, and the relative strength of national currencies. When you hear about oil prices spiking, you're not just hearing about gas stations, you're hearing about the immediate repricing of risk across every asset class, from bonds to emerging market equities. The two most important benchmarks you need to understand are WTI and Brent. WTI, or West Texas Intermediate, is the benchmark for U.S. crude, sourced primarily from the Permian Basin and delivered to Cushing, Oklahoma. It's a lighter, sweeter crude, which makes it easier to refine into gasoline and diesel. But its pricing is heavily influenced by domestic U.S. logistics, pipeline capacity, and inventory levels at that specific Cushing hub, making it a more localized indicator of North American supply and demand. Brent, on the other hand, is the international benchmark. Sourced from the North Sea, it's a global reference point for over two-thirds of the world's crude, including the Middle East, Africa, and Latin America. Brent prices carry a geopolitical premium because they respond directly to shipping routes, OPEC+ production decisions, and global supply chain vulnerabilities. The spread between WTI and Brent, known as the arbitrage, tells you a lot about global versus regional imbalances. A widening spread often signals U.S. oversupply or a global supply shock. For currency traders, oil is a fundamental driver of the commodity currencies, the loonie, the krone, and the ruble. The Canadian dollar is a more volatile beast. It's tied to oil but also to sanctions, capital controls, and local fiscal policy. Oil price spikes can provide temporary support, but the rub's reaction is often muted or distorted by geopolitical risk factors. The interplay between oil and inflation is critical to central bank reactions. Higher crude prices feed directly into headline consumer prices, forcing central banks like the Federal Reserve and the European Central Bank to maintain tighter monetary policy for longer. This creates a feedback loop where rising oil strengthens inflation expectations, which in turn strengthens the US dollar against other currencies, even as it structurally weakens oil-importing economies. Geopolitics is the electric chair for oil prices. A disruption in the Strait of Hormuz, a drone strike on a Saudi facility, or a new round of sanctions on Russian exports can send Brent spiking 10% in a single session. These shocks force currency pairs to gap, and you see sudden safe haven flows into the dollar or Swiss franc, while oil importers like Japan and India see their currencies deteriorate rapidly. The key takeaway for any trader is that oil is not just a commodity, it's a macro indicator that you must monitor daily. Watch the EIA inventory reports for WTI, watch the OPEC+ monthly announcements for Brent guidance, and watch the geopolitical headlines that create volatility. The relationship between oil and currencies is not static, it shifts with the economic cycle, with the level of global risk appetite, and with the relative health of the U.S. refining industry versus the rest of the world. Understanding this dynamic gives you a substantial edge when trading pairs like US dollar to Canadian dollar or euro to Norwegian krone.